One, today we will be doing a project, a business analysis project, to determine if a property is worth investing in or not. Now, we have two metrics we want to determine to be able to understand if we have to invest in this property or not. And one is cash on cash return, the other one is ROI. Now, what is cash on cash return? Now, cash on cash return is defined as a rate of return used in real estate transactions that calculates the cash income earned on the cash invested in a property. While ROI is a measurement of how much money or profit you have earned on an investment as a percentage of its total cost. So as we continue with the project, you will understand these two different metrics and why they are very important to metrics for us to calculate, to be able to determine if this house property is worth investing in or not. As business analysts, our employee, our management will always ask us to make some analysis to determine if they can invest in one thing or the other, and ROI is a very good metrics in doing this. So but for this particular project, we will also determine if this is worth investing on by also using what we call the cash on cash return. So let me read the problem statement and let's go straight right into it. I'm so excited, and I hope you are excited to join me in this particular project. Thank you. Now, the project statement reads: if a house property is offered for sale at $250,000 and the house monthly rental worth is $1,500, should we invest in it or not? Now, when we have such information, we have to do calculation to determine if it's profitable. If it's profitable, secondly, to how length, to how extent is the profit? Is it something that is worth, putting such huge money or not? So let's go into this, into the project proper and see the way I will break it down. So you can also use this same form to also build or solve the same problem in your different companies. Right now, let's go right straight into it. First, I've been able to put some of the values that we need to calculate so as to make this video faster. Now, the first thing we need to do is to calculate our investment. We mean by what are we going to pour in to be able to get this house. So first, we are going to write investment, then purchase price property. We were given that as $250,000. So let's put that information here. So we have the purchase price of the property as $250,000. Then definitely you are going to have other things that comes with buying of the house. Now, for buying of the house, there is going to be things like taxes and fees. There is going to be closing costs, and there is going to be a realtor fee, and maybe you are going to make some repairs also. So for every investment calculation, they have unique things that are attached to those costs. For example, if we are talking about if we are to calculate or to determine something on machinery, maybe those variables will be different. We may be having transport costs of carrying the machinery, and also installation costs of installing the machine in your company. So these are different. So there are unique values attached to different kind of projects or investment. So for property, we are going to have tax, we are going to have closing costs, and we are going to have realtor fees, because these are very, very important. So when you buy a property, definitely there are some, for every payment made, there are some taxes that will come with it. So let's put in the value. So these values are given. Let's say that you have 0.5% as your taxes. Then you also have So let's put the values 0.5%. Now for closing costs, that is, the closing cost means the lawyer, some appraiser, definitely if you want to get a property, you need a lawyer. So let's put that at 1%, which the lawyer will ask you to pay for standing in for you. Then we also have the realtor fee, that is the agent or agency that actually brought this particular investment to your company. So let's put that also 1%. Okay, then we have rehab cost. Okay, let's assume that the rehab cost is $4,000. Okay, so let's put that there. All right, now other expenses, let's just assume that we don't have any other expenses. So all these are assumptions, right? Okay, now so let's do the calculation to know our total investment. Okay, so that's the first stage we need to do. So we are going to use equals to get that. But before we do that, we need to calculate the monetary values of all these percentages. Okay, so for the first one, we are going to use equals to tell Excel we want to use a formula. Then percentage to this amount multiplied, so this amount multiplied by 0.5%, and let's press enter. So that is going to give us 1,250. So also the same thing we are going to do with this 250 multiplied by 1%, and we hit enter. So this is going to give us 2,500. Then also we are going to do also on this, so 250 multiplied by 1%, and we are also going to get 2,500. Okay, so now what we will do is we have to add up this total cost. So for this other place, you can also use absolute references, but I want to keep it so simple. So this place, I can also use formula text. I want to use formula text. So what is formula text? Formula text will help us see all the formulas that we have used, so that if someone is viewing your project, they will be able to see all the different formulas, how you have applied them. So I'm going to apply formula text to this and close the parentheses, hit enter, and you can see the formula has shown. So formula text is a very good function in Excel. All right, now let's continue. So what we need to do is to calculate the total investment, the total money spent. We use the equals to sign to let Excel know that we want to do a calculation. Then we are going to add up everything, so which is sum. Okay, I'm going to tell Excel I want to do an addition. So I open parentheses, pick the first value. All right, then I'll pick the last value, okay, which is 0. Right, close parentheses, hit enter, and you can see. So the total money spent is 260,250. Okay, so I want all the formulas to show, so I'm going to take it from here and I'll double click and it's going to show all the formulas. Okay, so it's going to show me all the formulas. So I want to pick all the formulas and you can see the whole formula. So we don't have formulas here, that's why we have NA, so I can delete that and delete this. So you can see we have all the formulas: C3 to B4, C3 to B5, C3 to B6, and this is giving us equals to sum C3 into C8. Okay, so these are the formulas. So the total investment here is 260,250,000. So that's 260,250. Okay, dollars. All right, so that is our total investment. So the next thing is for us to go to the next stage. What we would like to know our own equity and our resulting financial requirements. Now, what this particularly means is if we as a company is investing in this, we may not have all the cash. Most time when it comes to property, people pay some part and actually use bank loans to actually fund the remaining cost. So now let's say that we have 60,000 in as our own equity. Okay, so let's put that $60,000. So this is what we have. So definitely $60,000 cannot pay 260, right? So we need to have some required amount we have to borrow from the bank. So this also have to be captured in our calculation. So definitely if we have $60,000 and the total amount needed after calculating the total investment is $260,250. So what we do is we have to subtract our own equity from the total investment. Okay, then that will give us the total amount needed as loan, which we can get as loan from the bank. Okay, so now let's calculate that. So we are going to use equals to sign just the way we did the first one, and I can click direct. So total investment, which is C9 minus our own equity. So when I click enter, you can see that we still need about $200,250. Okay, so let me also use formula text. I want it to see all the text, all the formulas are used. So formula text, okay, formula text, I open parentheses, then I'll click the cell where I want to see the formula, then I'll close parentheses, hit enter, and you can see C9 minus C11. Okay, so this is the resulting financial requirement. Okay, now definitely this is what we'll need for the bank. Then the next thing is to go into how we get this money from the bank, and definitely the bank will ask us for to pay interest on this loan. So everything will have to be captured. So we are still into how we got the whole money to actually invest in this property. $50. Okay, so definitely we are going to get that from the bank as a loan. All right, now to get that money from the bank as a loan, definitely the bank is also going to charge us interest. There is going to be interest on every loan, and this is how banks also make their profit from every loan they give out, right? Okay, so we have to put in all this information, then we will now determine how much we will be paying back to the bank every month, because the bank has to take back this their principal amount, which is $200,250, and also the interest on this $200,250. You should know that when paying back to the bank, if you calculate the total amount you are paying back, definitely will be $200,250 plus interest. So apart from this principal amount, you are also paying an interest on it. So there is a formula in Excel that we use also to calculate this amount to pay back, and that is what we call the resulting monthly loan payment. So we'll come to that. So first, let's assume, because we are using a lot of assumption here, let's assume that the annual interest rate is 5%, is 3%. Okay, so I'm going to put 3%. Let's say that is the rate the bank is requesting. Then the terms of loan in years, let's say the bank has given the company 30 years to pay back this money. Okay, so to calculate the resulting monthly loan payment over these 30 years, we use the PMT function. So the PMT function in Excel. So this PMT actually shows us calculate the payment of a loan based on constant payment and a constant interest rate. So that is your PMT. All right, so we have a constant interest rate, and also with the constant payment is what we want to calculate, so that every month this is an amount you must pay to the bank, and this is going to be our first line to cross. Now we have to determine if this amount is viable or not, if the company can actually pay it or not. So let's calculate it to know. So this is our first point of analysis to determine if we can go ahead with this or not. So now let's open parentheses. It shows that we should calculate the rate. So the rate is 3%. So we are going to have 3%. So I'm going to click here, divided by 12 because we are now calculating in month. This 3% is annual rate, so we are going to divide it by 12 to be able to get what monthly rate, because we have 12 months in 1 year. Okay, so then we put a comma. Then the next thing is we need to calculate the MPER. Okay, ER is the terms. Okay, so our terms is 30 years, right? So we are going to use 30 years, okay, multiplied, because everything has to be in uniform. So since we are dealing in months, so we are going to multiply by 12. So this value, 30 years multiplied by 12, will give us the total terms in year, means the number of years to pay back this loan. Okay, so we'll put a comma. Then the next thing is PV. PV means present value. So the present value of the cash is what? 250,000. So we are going to click this, so we have that information. Then put our comma. Then the next information is FV. You can see it here, FV. Now FV means future value. Now we don't need any future value because the bank needs its money to be collected every month, so they are after this. They are not after any future value of that money. So for that, we are going to leave it at 0 or put another comma. So you can see I have 2 commas here, right? Okay, now the next is type. Now for type, we have 0 if we want to pay at the end of the month, and we use 1 if we want to pay at the beginning. You can see it here, end of the year 0 and beginning of the period 1. So I want to pay at every beginning of the period, which means beginning of the month. So I'm going to put 1. Okay, so we put we close the parenthesis, then we hit enter. So when you hit enter, you can see we are going to pay 842.16. Now this is coming as negative because you are paying out. When you have information in red or any value in brackets in accounting, means it's negative. Okay, so that is why we are having this information. And definitely because we are going to, this money is what we are going to pay out, it's giving us negative. So this is good. So what we are going to pay out every month is $842.16. Okay, $842.16, and means we are going to pay this $842.16 in 30 years. So definitely for this amount, if we calculate it multiplied by 30, it will be more than this. So the extra amount on it will be that this interest, this 3% interest rate. That's what it means. All right, now let's go to the next. So now that we have been able to take care of the total investment and the money, the total money that we are going to pay back to the bank every month, then we need to look at our own revenue. Now, what are we going to gain from renting this place out every month? So we need to look into it. So these are the values here. So now the rental income per month. Okay, let's assume that this particular property, we are going to get 1,500 from it every month. Okay, so that is what we are going to get from it every month. And let's also check that if the place has a parking space, maybe you can rent the parking space out and make some money. Or you can also if you have a shop just by the inside the same building, you can also rent it out for people who do laundry or other services. But let's assume this is 0. Let's assume there is no parking space and there is no shops there. Okay, so this is a model actually. So if you have that, you have to put the information here. That's the amount you wish to rent it out, or the amount obtainable to rent it out. Okay, so that is going to actually add to your monthly revenue. Okay, but when you don't have, you leave it as 0. So this model and building is a model that you can use for different scenarios. Based on this, you can actually add or subtract. Okay, so that's why I'm putting some of those value and using 0. But if you have that information, you can actually put the value there. Okay, so now so let's reserve for vacancy on rent income. Now definitely you will have some months whereby, let's say you rented it out for first 5 months, the tenant packed out, and you have to spend another 2 months to get another person to rent it. So definitely you will not have anything, you will not get any payment within that 2 months, right? So let's assume that this particular time is 8% of your total for the year. Okay, so let's assume that 8% of all your total revenue will be lost due to the time difference when a tenant will go out and you get a new tenant. So that period you are not going to get anything for your rent, right? So let's assume it's 8%. So 8%, we can use equals to sign. So 8% of the one of this amount, right? So that will give us per month. Okay, so we are going to hit that, multiply by 8%, hit enter, and we have 120. So let's assume that we have to remove this every month as our amount reserved for in case there is vacancy. Okay, so now to get our total revenue here is we are going to compute everything. So we use equals to, click 1005. So because this is a negative, because we are going to remove this, so I'm going to use minus 120. So when I hit enter, our new revenue is 1380. This is the real revenue. Okay, so this is the real revenue. So I can also use formula text by using equals to formula text. Okay, open the parenthesis, hit that cell where I want the formula to show, close it, and hit enter, and you can see. Okay, so now that we've been able to get our monthly revenue, also there's something we call monthly expenses. Okay, so we have to impute our monthly expense stuff here, because I would like to put insurance. Okay, so let me add one cell above. So I'm going to add one cell. Okay, so I'm going to insert one cell. All right, so I've done that successfully. All right, so other expenses 0. Then let's add insurance. Okay, so our insurance, let's assume insurance is $25 every month. Okay, so $25, we put it at the cash side. We have two parts here where we have the percentage, and when we put the monetary value here. Okay, so when it's monetary value, you put it here. When it's percentages, you put it at this side. Okay, before you do your calculation. All right, so now that we have our maintenance and repair on rental as 2%, property management and rental 7%, then on rental income. Okay, then real estate tax on property income. So the property itself is the amount used in buy the full property. Other expenses 0. Then insurance, let's say $25. Okay, so now to have our total expenses, we have to convert all this percentage to values, right? So we use equals to sign. So 2% of what is the income. Okay, the income is the amount we rented out the property every month, and that is 1,005. Okay, so we are going to use this multiplied by 2%, and we get 30. Okay, same thing can be applied here. We can also use absolute references, but just as I said, I want to keep this very, very simple so that everybody can understand it. So multiplied by what? 1,005. Okay, the same thing, and we have 105. Okay, so for this real estate taxes on property income, use equals to 1.5. This time we are not going to multiply this by 1,005 because this is real estate tax on property. So the income or the amount of that property is what? $250,000. So this is what we are going to percent. We will not multiply it by 1,500. We are multiplying by the property income, which is 250,000. That's the cost of buying the property. Okay, because this percentage, this tax is based on the value of the property. Okay, so now this is yearly, is paid yearly. This amount, this real estate taxes on property income is paid every year, 1.5%. So what we do is we are going to use equals to 1.5 multiplied by this amount, which is the value of the property, divided by 12, because what we want to do is to get it per month. So this 1.5 is per year. So to get it per month, since we have 12 months in 1 year, we divide it by 12. So hit enter and you can see we have 312.5. So let's use formula text. Okay, formula text. Okay, to get out the formula. I like writing all my formulas out. This makes it easy for anyone to go through what I've done and understand what I've done. Okay, so I'm using equals to formula text. Okay, so I'm going to open parentheses, click on the cell which I want to see the formula, close parentheses and hit enter, and you can see the formula is out there. Okay, so now for insurance, let's assume that we are paying $25 every month to an insurance. So other expenses, this is a model. That's why on most of all the calculation I've been doing, on each part I always put other expenses, so that if you have other expenses in your own model, you can add it. So I'm going to write 0 there. I don't have any other expenses. So now I'm going to add everything together, so that this is going to give me equals to sum. Okay, then I'm going to open parentheses so that I can add all the values here. So I'm picking the first value, which is C30, and I'll pick the last value, which is 0. So that is the range from year to year. So I want to get my total expenses. So when I hit enter, this is going to give me 472.5. Don't forget, when you have total expenses, it has to be negative, because total expenses means is things that is money spent out of what you have made out of this total revenue. So let me adjust the formula again. So I'm going to use minus bracket. So I'm going to use minus, and every information, every other thing will be in bracket. Okay, it will be in parentheses. You can see, so I now have double brackets here, minus. What this does is that every value here will be converted into minus or negative. So let me click enter, and you can see minus 472.5. So I can also write formula text. Okay, so this makes the calculation easy for me when I put the right symbol by the value. Okay, so formula text, I'm going to open parentheses, click on the cell and close parentheses, hit enter, and you can see we have the formula here, equals to open parenthesis sum into our range, double bracket, close. All right, now that we have been able to get our total sum, so now to calculate our monthly cash flow, because we need the monthly cash flow to be able to calculate our cash on cash return. Okay, so what I need to do, let me bring it up a little bit. Okay, so it can be visible, very visible. So our monthly debt service, the revenue 1380, our monthly expenses minus 472.5. so these are values we already have here. You can see them. Our total expenses minus 472.5, which is this, and going forward you can see our total revenue, which is 1380, which is no more 1500, because we have actually made some expenses. Then our resulting monthly loan payment is 842.16, which we are paying back to the bank. So those are the three values I've brought down in this particular place. Okay, so let me okay, so you can see it properly here. So these are the three values. So to calculate our monthly cash flow, because I need to calculate the monthly cash flow to be able to determine the cash on cash return, to be able to use it on this cash on cash return method. Okay, so now I'm going to use equals to because I have to add everything together. So I want to sum everything. Okay, sum. So definitely Excel is going to use board mass. All right, so there's no issues. So I'm going to pick the first range, and I'm going to pick the last range just as we have been doing, and it's going to take everything in this range. You can see it has highlighted all the whole values, okay, in all the cells or in that column. All right, now let me close parentheses, hit enter, and you can see our monthly cash flow is $65.34. so means after we spend everything, every month we'll be having $65.34 remaining. Is this good? Is this bad? Well, I can't really say, but we can still continue. So at least from here, we can actually calculate our cash on cash return and be able to determine if this business is, good to go or not. Okay. So now let's go into our cash on cash return. Okay. For our cash on cash return, so the next thing is to calculate our cash on cash return. So we want to use our cash on cash return method. So what we do is we need to know our yearly cash flow, and already we have our invested equity. So for our cash on cash return means we are going to divide our invested equity by the yearly cash flow. So first let's compute for yearly cash flow. So yearly cash flow will be equals to our monthly cash flow, which is this value, multiplied by 12, right? So let's click enter. So our yearly cash flow is $784.12. Okay, so our invested equity is $60,000. Okay, so our cash on cash return will result to our invested equity divided by our yearly cash flow. Okay, so now what we do is we take our yearly cash flow and we divide it by our invested equity. So let's run it, and we have $0.01. Okay, and this can also be converted into percentage. Okay, so what I will do is to go to home. So I want to know how many percent and convert this currency. You see it's currency, that's why we have currency here. So convert this currency to percent, and that is 1%. So what we have here is, then I can also highlight it with this blue. Let me go to home, and I want to highlight it with this blue, okay, because it's a very important value. So our cash on cash return is 1%. Okay, so our cash on cash return is 1%. Fine, we have is actually low, but one thing we need to know is we are paying all this money every month. Means anytime we pay, there is also another, I want you to know that there is also another profit somewhere, though it's not in cash, but it's actually property. Anytime you pay this money, you are one step closer to own the property. Means in 30 years time, you will be getting $784 every year, and at the end of 30 years you also own the property. So if you look at it from that view, it is actually good. It is actually profitable. It is actually good to invest in this. You can see from where it's coming from that every month you must have money coming to your account. Though it's low, but at least you have money coming after paying every other money. So you have $65.34 coming to your account every month. Okay, and every year you are going to earn $784. Fine, even if the money is low. Important is when you have a cash flow that always bring that is positive, then it's good. If we had a cash flow that is negative here, means you will still be paying more every month. So that is when it's not good to invest. But you are going to receive money into your account because this is positive. That is good. And at the end of the day, after 30 years, you are still going to own the property. So this is very good. So let's use our ROI. Let's use ROI, return on investment, and let's also check which particular value will get there to determine if overall this particular investment is to calculate the ROI. Now we are calculating the ROI without the principal pay down. Now you should remember that the principal payment, which is the principal pay down, is already a profit, it's already an advantage. So it's already something positive for the investment, because for any amount you are paying down from this principal pay down, you are getting closer, you are buying equity, means you are getting closer to own the property. For every payment you make every month, you are getting closer to turn the property into yours. So since we know that is already positive, what we are interested in is the interest. So that is why we wrote ROI without principal pay down. But you can remember that for cash on cash return method, we actually used everything, this 842, okay, which comprises of both the monthly interest and the principal pay down. But now we want to calculate the ROI based on the interest. That is why we said ROI without principal pay down. So to be able to separate this 842.16 into two, which means we have to have a value for monthly interest payment and a value for monthly principal payment. So how do we calculate it to separate it? So we have to separate them into two different values, and we use this monthly interest payment to calculate our ROI. So what we do here, what we have to do, pay down. Okay, now for us to calculate ROI, we are interested on the interest, and in this particular case, you can see that we have monthly interest payment and monthly principal payment. And you should remember that this total payment, the addition of this total payment makes this 842.16, which is in red, which is debt, which we pay back to the bank every month. But out of this payment, one is an interest on the loan collected from the bank, and the other is actually a principal pay down. Means anytime we pay this money, this 842, this monthly principal payment out of it is actually an equity. Means that we are one step closer to owning the house, while the monthly interest payment is actually the amount the bank is collecting. This is an interest payment for the bank. This is what the bank is going to collect. This is what where the bank is making its own profit from the loan they have taken, you have taken from them. Okay, so now we need to we need to break this thing down, because for us to calculate the ROI, we only want to deal on the part where we have made profit, and where we have made profit is this monthly cash flow, which is 65.34, and also the monthly principal payment, because we are making profit here because we are gaining equity. We are getting one step closer to owning the house anytime we pay this debt, right? And also the monthly cash payment, after paying everything, we still have 65.34. So these two values is what we need. So how do we divide this 842 into these two to actually have this monthly principal payment, which we need to calculate our ROI? So what we do is we have to use what is called the cumulative IPMT. So this is going to be equals to cumulative. So this is going to be equals to cumulative IPMT. Okay, you can see cumulative IPMT returns the cumulative interest paid between two periods. All right, so now once I open the parenthesis, it's going to give me the values I need. Now what it says here is cumulative IPMT, that I should put the rate. Okay, so now the rate is what? The percentage, the annual interest rate, which is what? 3%. So I will click it, 3%. Then I will check it down here. So I have to take it back. So we have to be going back and forth. You can see B16. So what I'm going to do here is I'm going to divide it by 12 because that actual interest rate is what is on a yearly basis. So for me to take it into month, because my calculation here you can see is monthly interest payment. So I'm going to divide by 12. All right. Then the next step is we need the MPER. Okay. The MPER is the number of years. Okay. So now the number of years for this loan is what? Terms of loans of year is what? 30 years. So I'm going to click 30 and it's going to come down here. So for 30 years, you can see, I'm going to take it back here. So for 30 years, we have our B17. So what we do is I'm going to multiply it by 12 because it's in years. So I want to take it to years. Okay. So I'll put a comma. Then the next information that we need is the PV. And what is the PV? The PV is the present value of that money, of the loan taken from the bank. And what is the loan taken from the bank is what this resulting financial requirement. So I'm going to click it. That is $250, $250. So I'm going to click it also, and it's going to appear here. Okay, you can see it when I click it. C12 is here. So the next thing is we want to know our start period. So the start period of paying back this interest is what? The first month. So we are going to use 1. Okay, so we are going to use the first month of the whole period, which is 1. And the end period definitely is at the end of the 30 years. So I'll go back to the years and click that. Okay, so I'm going to go back to the number of years, which is what? Terms of loans in years, which is 30. So I will click that. Then I'll go back to where our formula is. So we are building the formula using the cumulative IPMT, right? All right, so you can see B70 has appeared, multiplied. Okay, don't forget we are taking this in months. This 30 is in years, so we multiply by 12. So we put a comma. Then what is the last one? Is type. So the type means you can see 0. We use 0 if we are paying end of the period, that is maybe end of the month, or beginning of the period, that's beginning of the month. So I'm choosing 1 because we are paying beginning of the period to coincide with the PMT function I used earlier on, formula I used earlier on. So I'm adding 1. So if I click bracket, then the next thing is divided because it's in average. We want to have the average cumulative IPMT, the interest payment every month to the bank. So I'm going to have, so the average of it is going to be the total period. So the total period is what? 30. So I'm going to divide it by the total period, which is 30. Okay, so I'm going to divide by the total period, which is 30, and you can see it here, B17, right? So 30, don't forget, is by month, so I'm going to multiply by month, and definitely I'll put them in one bracket so that they can actually use a mathematical expression whereby things in the bracket like BODMAS, the function there will compute itself as the values there will compute itself before we divide by this total. Okay, so don't forget that. So we click enter, and you can see we have minus 285.9068. So this is the monthly interest average month. So the next step is to calculate our monthly cash flow and our monthly principal pay down. You can remember these two are our profit. Our monthly cash flow, if you remember, let me take you back. Our monthly cash flow is 65.34, which is the value we got from this place, right? So 65.34. So we can actually put that value here by pressing equals to, press this and hit enter, and it's here. Okay, so now that we have our monthly cash flow, this is a profit. Our monthly cash flow is actually a profit in this particular business because this particular investment, after paying every money to the bank at the end of the month, we still have $65.34. This is in cash. Then there is another profit, which is our monthly principal payment. You can remember, even if we pay this to the bank, it's a payment in equity. Sorry, it's a profit in equity, because when we pay this amount with this amount to the bank, which is 842, part of this represents your equity. Means anytime we pay this 842.16, 556.25, it's your profit also. This is your profit in equity. In as much you are not going to take this in cash because you are paying back to the bank, but it takes you one step further to owning the property. That's what it means. So this is good. So right here we are going to fix this. So now it's going to come in as positive. So we are going to write 556.25. okay, so we hit enter and that's it. So I'm going to change this also to $sign because it's being paid in dollars. So when I hit dollar, you can see 556.25. Now what I will do, our monthly cash flow, interest only, you can see we want to calculate all the total interest. The total interest we have here is the interest in cash flow, which is 65.34, which we have in the profit cash at hand at the end of the month, and this 556.25, which is equity, which is an added advantage. Means anytime we pay this, we are one step owning that property. So it's also a profit in property. Okay, so we are going to add both of them. So this is going to be equals to 6534 plus 556.25. So when we hit enter, we are going to have 621.5 now. Now this is the monthly cash flow, interest only, by adding both of them. So now for us to calculate our ROI is calculated yearly, right? So now our yearly cash flow, so we need to convert it to our yearly cash flow. So we are going to have equals to this value multiplied by 12, because we calculated this in monthly. So now we want to calculate the yearly cash flow. How much in interest are we having in the cash as profit for us? So we multiply that and you can see we have $7,459.12 in yearly cash flow. So now what is our invested equity? So our invested equity is 60,000. okay, so we are going to fix that there. So our ROI, our rate of return, will be equals to, okay, so we are going to have our yearly cash flow divided by our invested equity, and that will give us our ROI, and you can see is 0.12 in dollars. So we can change this to percentage. Okay, we can also change this to percentage by going here home, because ROI is best calculated in percentage, and we hit percentage and you can see 12%. Now if you have a profit and ROI of 12%, this is actually a very good business. So it's very good to invest in this, in as much that after getting loan from the bank, you can actually pay and always have $65.34 as extra cash on your hand, and every month also you have paid at 556.25. okay, well, this is good, because as you are paying the bank, you are also collecting rent from the shop, from the house. So you are, as you pay the bank, you are also collecting rent from the property. So this gives you an added advantage. So as you pay what you get from the revenue generated from the house, you are also gaining extra 65.34 in cash at hand every month. And also every month, out of what you are paying back to the bank, which is minus 842.16, you are gaining 556 of it as down payment, as extra payment you pay every month for that house. Means as you continue to pay this month in, month out, you are gaining you are gaining equity. Means you are one step closer owning the property. Means you are gaining this and gaining this. You are gaining this in cash, and you are gaining the monthly principal pay down in equity, as in owning the house. So this is a very good business when you have an ROI of 12%. So thank you so much. This is how we do this investment calculation. So with this information, I can advise my management to actually go for this investment. Thank you for staying with me. Please don't forget to like, subscribe, and comment on our videos. Thank you so much. I wish you a great day. Bye bye.